Most successful business owners eventually face the same problem. Not how to make more money, but what to do with it. You've built your company, you've built your brand, you've got cash piling up in your holding company, but that cash, it's losing value to inflation, it's fully taxable on interest, and it's not really doing anything for you right now. In today's video, I'm going to walk you through how one Toronto entrepreneur transformed his corporate cash into a long-term wealth engine, and the 3 key lessons every Canadian business owner can learn from this story. Hi, I'm John Orr. I'm one of the co-hosts of the Canadian Wealth Secrets podcast, and I'm also the Chief Operating Officer at Canadian Wealth Secrets, where we help business owners strategize their wealth building plans. So I know a thing or two about how to make this. So I know a thing or two about how to think about your retained earnings inside your corporation. For incorporated professionals and business owners, the problem often isn't income, it's efficiency. You have your operating company, a holding company, maybe even a real estate company or a building company. Together, they create a web of cash flow and retained earnings. But unless that structure is working strategically, you're likely missing out on significant long-term advantages, both tax and wealth building. And that's exactly where Raj, our business owner, found himself. Raj runs a successful event production company in Toronto. And after 20 years, he built a multi-million-dollar business with 2 properties and several related corporations. Like many founders, he was comfortable taking dividends when needed and leaving the rest in his holdco. Roughly $500,000 in retained earnings was up there. But as his business grew, so did the stakes. He and his partner had just invested heavily in new equipment, about $600,000, and were finalizing a shareholder agreement. The question that changed everything was simple. If something happens to either of us, how does the other buy out the shares without jeopardizing the company? That's where we started building a coordinated plan that turned the idle liquidity into long-term strategic assets. The first lesson is structure drives opportunity. Raj has 3 corporations, his operating business, a holding company, and a real estate company. Once we clarified ownership and cash flow between them, we could align the insurance inside the right entity. A properly structured corporate-owned whole life policy can accumulate tax advantage value and still be accessible through policy loans, providing liquidity when needed. This is his wealth reservoir. The second lesson Raj needed to learn is liquidity with purpose. Instead of leaving cash idle in a low-interest account, Raj directed a portion into a participating whole life policy. This didn't replace his operating capital, it actually enhanced it. His company retained access to those funds, but now they were working within a tax-efficient compounding structure that also protected his partner and his family. The third lesson for Raj is integration. This wasn't about selling a product. This was about aligning the moving pieces. We worked alongside his accountant and his lawyer to ensure the shareholder agreement, buy-sell clause, and dual wills all pointed in the same direction, and the result was a coordinated plan. He has a short-term term insurance for key person risk accounted for, long-term whole life for capital growth, and clear documentation for succession and estate efficiency. Today, Raj's business runs smoother, and his companies are no longer sitting on idle cash. The corporate policies now act as private reserve, that wealth reservoir. They're liquid, they're growing, and they're tax advantaged, ready to fund future opportunities or potential buyout down the road. And personally, Raj says the biggest shift wasn't financial, it was mental. He says, for the first time, everything connects: my business, my family, and my future plans. So if you're a Canadian business owner sitting on idle, excess corporate cash, this is the moment to be strategic. You can use tools like corporate-owned insurance, not just for protection, but to build stability and flexibility in your company. The key is integration, aligning your cash flow, your shareholder agreements, and your long-term goals so that every dollar has a purpose. When those pieces connect, your business becomes more than just income. It becomes your legacy. If you'd like to learn how this kind of planning could work for you, then book a discovery call with our team at CanadianWealthSecrets.com. We help you see how your corporate structure, your insurance, your wealth plan could all interact and work flawlessly together, just like Raj's did. I'm John Orr, and this is the Canadian Wealth Secrets podcast. We'll see you in the next episode.